Good day traders, it's Monday, September of 19th, and this is Alan Hong, market analyst of GKFXPrime. I'm gonna share my daily analysis through this video. So first of all, let's review the major market movements. And the first instruments we're referring here is the US dollar index in 4-hourly charts. So the US dollar index, which measures the greenbacks rank against a trade weight basket of 6 major currencies, was fell lower on Friday and down 0.25% to 91.8 after retail sales data unexpectedly undershot expectations in August, while sterling rose to its highest level since June last year, adding to downside momentum in the greenback. So a sluggish month for motor vehicle sales weighed on the retail sales growth in August, suggesting that consumer spending in the third quarter may come under pressures, tapering investors' expectations of a strong third quarter economic growth. So according to the Commerce Department said on Friday, retail sales of United States was dipped 0.2% last month, missing the expectations of a 0.1% rise. So the soft retail sales data came just hours ahead of manufacturing and consumer sentiment that topped forecasts. And the New York Empire State Manufacturing Survey was declined to 24.4 for September from 25.2 previously, although this was significantly above the consensus expectations of 19. So after hitting the 7-month high in August, the Consumer Sentiment Index, a survey of consumers by the University of Michigan, was fell to 95.3 in September, but handily topped expectations. Meanwhile, the sterling's added to gains from the previous sessions, surged 1.29% to traded around 1.3571, hitting its highest level since the Brexit vote and peeling further pressures on the greenback after the Bank of England committee member Gert-Jan Willink said the moment is approaching for a rate increase. Looking into Japanese yen, the pair USD JPY was rose 0.54% to traded around 110.85 as the safe haven demand was eased following an earlier spike in the geopolitical uncertainty after North Korea launched missiles over Japan on Friday. Having a tad in commodities markets, the gold price was fell lower on Friday, down $2.91 or 0.22% to traded around $1,326.39 a troy ounce as investors shrugged off the rise in the geopolitical uncertainty that followed after North Korea launched missiles over Japan on Friday, while growing expectations that the Federal Reserve will hike rates later this year kept the precious metals on track for weekly lows. So a day after data showing inflation rose to its highest in 7 months, fueling expectations of a December rate hike. So gold price remained on track to snap 3-week winning streaks. Losses, however, were limited by weak US economic data. So according to the Federal Reserve Rate Monitor tool, more than 50% of traders expect the Federal Reserve to hike rates in December. And gold price is sensitive to move in the US rates, which leave the opportunity cost of holding non-yielding assets such as bullion. As for the oil price, it was settled higher and racking up their biggest weekly gain since July on Friday, amid rising expectations that higher oil demand will reduce excess crude supplies to OPEC's 5-year average target. So OPEC says production in August was fell by 79,000 barrels a day to 32.76 million, as falling production from Venezuela, Iraq, the UAE, and Saudi Arabia was offset the rising output from Nigeria. So OPEC Secretary General Mohammed Bakindo said it is clear the rebalancing process is underway. So this was expressing the optimism that growing demand in the second half of the year would continue to dent excess supplies. So that was followed by the International Energy Agency report forecasting a surge in demand growth in 2017 by 100,000 barrels a day to 1.6 million barrels a day, or 1.7%. So the bullish outlook on oil demand lifted the expectation that the demand and the supply imbalance in oil markets would continue to narrow in the coming months. So the door of report overshadowed data showing US crude inventories, which rose more than expected last week as the fallout from the Hurricane Harvey, which tore through the US oil heartlands of Texas in August, so forcing the refineries to shut down weight on crude demand. So the post-Harvey refinery recovery is underway, however, as data earlier in the week from IHS markets indicated that 13 of 20 affected US refineries were restarting operations. So crude output is expected to remain subdued as the US oil rates continue to decline, pointing to a slowdown in production, which could bolster the crude prices. So oilfield services from Baker Hughes say its weekly count of oil rigs in United States operating was declined by 7 to 749. So the weekly rig count is an important barometer for the drilling industry and serves as a proxy for oil production and oil services demands. So according to a note from the commodity analyst at Schneider Electric, Robbie Fraser stated, on the US side, steadily declining rig counts of late have raised the possibility of stalled US production gains, with current output still holding below the pre-harvest level. And now let's review the highlighted economic data that released on Friday, as well as the focus data and event for today. So on last Friday, United States was released a series of data including the core retail sales, and also the Michigan consumer sentiments. So the core retail sales of United States in August was stated at 0.2% growth, which is disappointed compared to the economist focus of 0.5% growth. Alright, so as for the retail sales, it was at negative 0.2%, which is fell into the contraction territory, okay, compared to the economist's focus of 0.1% growth. So as for Michigan consumer sentiment for September data, it was at 95.3, which is better than the expectations of 95.1. So the last data on Friday is the US Baker Hughes oil rig counts, which show a result that was fell 7 rigs on last week, which from the previous 756 to 749. So as for today, Mondays, we got only one data and one event to be focused, sorry. So the only data will be releasing by the European Union, which is the consumer price index, also referred as the inflations, okay. So the inflations of the euro is expected to remain the same at 1.5% growth, alright. So besides of that, the Bank of England Governor Mark Carney will going to deliver a speech at 11 o'clock tonight. Alright, it's technical analysis sessions now. So first instruments, we're referring to the Great British Pounds against the US dollar pair in daily charts. So the sterling was added to gains from the previous sessions, and it was surged 1.29% to traded around 1.357, which hitting its highest level since the Brexit votes and peeling further pressures on the greenback after the Bank of England committee members Gudjan Wild said the moment is approaching for a rate increase. So currently the pair is hovering near to the next resistance level at 1.362. So referring to the MACD indicator, the both movement line remain expanding upward in daily charts, additional with the strong upward momentum. So with a daily closure above 1.362 will be a signal of continuations of uptrends and probably to move further higher towards the next resistance level at 1.377. So on the downside, the first level of support comes in at 1.342. So the British economic calendar will bring on Monday as Bank of England the Governor of Bank of England Mark Carney will delivering speeches to the market, which can give traders further indication into the timing of tightening their monetary policy. The single currency remained traded in an uptrend structure against the greenback, following rising expectations on European Central Bank to tightening its monetary policy end of the year. So in order to prevent the overheat on inflation, so the pair EUR/USD was traded mostly flat on Friday after a retracement from previous high at 1.206 and from a double top pattern, and currently it is traded between 1.192 and 1.197. So with a closure above 1.198 in 4-hourly chart, we're suggesting for further upside, and with a daily closure above 1.207 will be a signal for continuation of uptrends and probably will surge higher towards the next resistance level at 1.22 as its long-term target. So on the downside, the nearest support level is set at 1.191, so closure below this level in 4-hourly chart will lead to extending its retracement periods. And Monday considered as a quiet trading day for the single currency, as without any important data and events from the European Union. The Kiwi was held steady in a range between 0.722 and 0.734 against the US dollar since last week. So currently it is traded at the high territory of the range, and failed to break out from the highest level of the range will be signals for it to move lower in short term and remain traded in the range. Otherwise, 4-hourly charts closure above 0.735 will suggesting for shifting trend directions become uptrend and expected to move further higher towards the next resistance level at 0.739. So on the downside, refer to the lowest level of the range at 0.722 as its support levels. So the pair is expected to be traded quietly on Monday as no important data or events from New Zealand. Thus, traders are recommended to focus on the greenback. Aussie was stood at the high field against the greenback for a retracement from previous high at 0.806. So it been entered the bullish trend since June, which bolstered by the weaker dollars, while stronger fundamental aiding to upside momentum in the Australian dollars. So by referring to the MACD indicator in 4-hourly chart, the both movement lines were crossed and expanding upwards, signals to move higher in short terms, and with a daily closure above 0.813, we're suggesting for continuation of uptrend and heading towards the next resistance level at 0.828 as its long-term target. So on the downside, its nearest support level can be seen at the important psychological level at 0.8. As for the safe haven Japanese yen, it was wiggled as the safe demand ease was following an earlier spike in geopolitical uncertainty after North Korea launched a missile over Japan on Friday. So the pair USD JPY was break out from the previous high of 110.8. Additional with a gap up on Monday, the pair suggested to move further higher and run into a short-term uptrend. So with closure above 111.4 will be a signal for further upside and refill the next resistance level at 111.7. On the downside, the first support level comes in at 110.4. Gold price remained weak on Friday as growing expectation that the Federal Reserve will hike rates later this year brought a weekly loss to the precious metals. So in daily chart, gold price remained hovering near the support level of $1,321 with a daily closure below this level will lead to experience a short-term retracement at fall lower towards the next support level, which is the psychological level at $1,300 a troy ounce. So on the upside, it is suggested to continue its uptrend with a daily closure above the previous high at $1,358 a troy ounce. As for the oil price, with the West Texas Intermediate crude price, it was settled higher and racking up its biggest weekly gain since July on Friday, amid the rising expectation that higher oil demand will reduce excess crude supplies to OPEC 5-year average targets. So it was extended its gains, followed by a daily closure above the previous high at $49.30 a barrel. But however, the strong psychological resistance level at $50 a barrel hit is suggested to be traded mostly flat unless it is is boosted by further optimism data on news. So with a daily closure above $50 a barrel freeze hold, we open up a door for a stronger bull, then refill the next resistance level at $51.50, and then on the downside, the nearest support level can be seen at $49.40 a barrel. To date, please don't forget to subscribe to our YouTube channel by clicking the GKFXPrime logo on the screens in order to follow our updated analysis and education video. Thank you for watching.
GKFX, your global trading partner.